Now in continuation to what we have done in the previous class, let's continue with solving some questions, and let us begin with question number 16. Let us read this question. XYZ Limited is evaluating a project which requires an outlay of rupees 16,000 and is expected to produce a cash inflow for 5 years as follows. If you can observe, the question gives you 3 different economic conditions with their respective probabilities and annual cash flow estimates. Assume that there are only 3 streams of cash flows as these are dependent over time. Now, this line clarifies one thing, that in case the economic condition turns to be good, it will remain good for all 5 years. If it is average, it will remain average for all 5 years. If it is bad, it will be bad for all 5 years. That means there will be only 3 streams of cash flows. In other words, only 3 different paths with the given probabilities and cash flow estimates. Discounting rate is 12% per annum. Determine the expected NPV through separate NPVs of each possible outcome and standard deviation with respect to NPV. So now solving this question is no big deal based on what you have learnt in the earlier class. So let me just help you to show how to present the solution. You start with the initial investment of 16,000, which is indicated as a negative cash flow. If the economic condition turns good, the annual cash flow will be 8,000 for all the 5 years, 8,000 per annum. That is identified as path 1. If it is average economic condition, it will be 5,000 per annum cash inflow for each of the 5 years, identified as path 2. And if it turns bad, it will be 3,000 per annum for each of the 5 years, identified as path 3. Now we have 3 different paths with their respective probabilities and annual cash inflows. We make a table to show the expected NPV for each path. So we start with path 1. Look at one thing. At 12% discounting rate, the annuity factor works out to 3.6048 and 8,000 is the annual cash flow. Multiplying these two would give you the present value of cash inflow minus 16,000, which is the initial investment, and what you get is the NPV for path 1. Similarly, you compute NPV for path 2 and NPV for path 3. Now we have 3 different NPVs and 3 different probabilities. When you multiply the respective probabilities to each of these NPV estimates, you will be getting the expected NPV as the aggregate of A into B column. So 3,826 will be the expected NPV. So please take note of this entire working and then I take you ahead. Alright friends, once you have completed this working, let us move ahead, and you know what you have to do next. Determine standard deviation with respect to NPV. So for this purpose, you know what you have to do. You identify NPV as X values, expected NPV as X bar, then you take deviations, that will be X minus X bar, consider the probabilities and take squared value of deviations multiplied by respective probabilities. When you apply these calculations, what you will get is the summation of D square into P, which will indicate the variance of project NPV, and the standard deviation with respect to NPV will be the square root of this variance, which comes to 6,498.65. So please write up this calculation as well, and that will be end of the solution. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question, that will be question number 20. Again, one of the very good questions from your institute study material, and of course a question that was asked in past exam as well. Question number 20, let us read this. Shivam Limited is considering 2 mutually exclusive projects A and B. Project A costs 36,000 and B costs you 30,000. You have been given below the net present value probability distribution for each project. Now look at the different style of information. They have already given you NPV estimates along with probabilities. Keep in mind one thing, these are not cash flow estimates, these are NPV estimates directly. Because these are NPV estimates along with their respective probabilities, we can directly find expected NPV by multiplying these respective probabilities to the given values of NPVs. So what is the question asking you? Compute the expected net present values of project A and B. Of course, when you find a question with NPV values with associated probabilities for the two different projects, you will be definitely expecting that question will ask you expected NPV calculation. Further, it is asking compute the risk attached to each project, that is standard deviation of each probability distribution. That means we have to find sigma NPV, that is standard deviation with respect to NPV. Then the question is asking you compute profitability index of each project. Of course, yes, the two projects have different costs. Now earlier part of capital budgeting, in the basic part, I have explained you when the two projects have different initial investment or the different value of present value of initial investment or outflow, you are supposed to consider profitability index for your decision. Then the question is asking you at the end, which project do you recommend? State with reasons. Of course, to answer the last part, our entire analysis will be based on the computation of profitability index and the computation of standard deviation with respect to NPV. So as far as calculations are concerned, you can just easily apply the calculations. So the expected NPVs for the two projects, whatever NPV estimates you have along with associated probabilities, you multiply the respective probabilities to the amounts of NPVs given to you, and the aggregate of that would give you expected NPV. And you do the same thing for project A and project B, and when you compute the expected NPV, for project A you are getting 9,000, for project B also you are getting 9,000. That means expected NPV wise both are same. But keep in mind one thing, what I explained you while reading the question, that because the cost of the two projects are different, NPVs are same, but we may not be applying the NPV criteria for assessing the selection of the two projects. We will rather use profitability index over here because NPV wise both are at par. So the one which has higher profitability index will be preferred. But we will compute profitability index when the time comes. First, I want you to write down this entire working and then we shall move ahead. Alright friends, once you have completed this entire working, let us move ahead, and now we compute the standard deviation of each project. We start with project A, and you know how to do this. We have been doing this kind of calculation in previous questions already. So you plot the NPVs which are given to you as NPV estimates, and notice one thing, we are identifying NPVs as X, expected NPV is X bar, so deviations will be X minus X bar, that is NPV minus expected NPV. So you identify the deviation for each of the NPV estimates. Some deviations are positive, some are negative. You identify the probabilities, and what you then do is you take the squared value of deviations multiplied to their respective probabilities, that is P into D square. So it will be 6000 into 6000 into 0.2, and what you get is 72 lakhs. Then 3000 into 3000 into 0.3, what you get is 27 lakhs. Similarly, 27 lakhs for the third one and 72 lakhs for the fourth and last one, and we get the aggregate of P into D square as the variance of the project NPV, and the square root of this variance would give you the standard deviation with respect to NPV, which comes to 4450. So please write up this entire working and then I take you ahead. Alright friends, after computing the standard deviation with respect to NPV for project A, let us move ahead and do the same thing for project B. I don't have to explain you again, it is just the similar type of calculation which is now meant for project B. The deviations are exactly same in both projects because NPV and expected NPV were same, but probability distribution is little different in this project, and therefore when you are computing P into D square, the variance of the project NPV is little different, and taking the square root of the variance you will be getting the standard deviation with respect to NPV, that comes to 3795. So look at one thing, project B's standard deviation with respect to NPV is lower than that of project A. So one thing is confirmed, risk wise project B is better because lower the standard deviation with respect to NPV, the lower is the risk involved in the project. Anyway, we will be writing those concluding points at the later stage. First you write down these calculations quickly. Alright friends, once you have completed this entire calculation, let us move ahead and determine the profitability index for each project. The profitability index is basically the total PV of cash inflow divided by the PV of cash outflow, or in other words, PV of cash inflow is nothing but the discounted cash flow. So discounted cash flow divided by the initial investment would give you the calculation required. The one thing that we have to observe over here, we don't know the discounted cash flow. In other words, the present value of cash inflow is not known. What is known is the NPV and the initial investment. So use your simple common sense. NPV, which is arriving as a 9,000, which was expected NPV, that 9,000 is NPV, and the initial investment in project A is given as 36,000. So do you know how do we compute NPV? It is PV of cash inflow minus PV of cash outflow. So if PV of cash inflow is not known, you can take NPV plus PV of cash outflow. Aggregate of these two will give you nothing but the PV of cash inflow or the discounted cash inflow. When you do this calculation, in the numerator you get 45,000, in the denominator you get 36,000, and the profitability index for project A comes to 1.25. I am sure you are aware of what is the meaning of profitability index. See, 36,000 of initial investment, that is present value of outflow, is resulting into 45,000 as present value of inflow. That means for every 1 rupee of outflow, your inflow in terms of present value is 1.25, and when you make that calculation for project B, it is turning to 1.30. So we find one thing, that profitability index of project B is higher than that of project A, which indicates that even profitability index wise project B is better. So we will be writing that conclusion definitely, but one thing is clearly observed, that project B is better from risk as well as profitability index viewpoint. So please write up this calculation and then I take you ahead. Alright friends, once you have completed writing these calculations, let us move ahead and write up the conclusion over here. The expected NPV of both the projects are same. However, the initial cost of the two projects are different. Therefore, profitability index will be a better basis for evaluation of the project preference. Based on profitability index, project B is better. Risk of the two projects will be assessed through possible dispersion from the expected NPV, which is indicated by standard deviation with respect to expected NPV. Lower the SD, the lower is the risk. So based on standard deviation with respect to NPV, project B is better. So please write up this entire conclusion, and that will be end of this solution. Alright friends, once you have completed writing this entire solution, let us move ahead, and now what we do, we write the heading application of Hiller's model. Just for you to remember, in the previous class, that is lecture 4, at the later part we have learned 5 steps that indicates the application of Hiller's model, and Hiller's model is applicable only when the cash flows are independent over time. So let us do one thing. Let us practice a few questions based on application of Hiller's model. I'm sure you have written this heading already, application of Hiller's model. Now under this heading, we begin practicing some questions, and we begin with question number 17. So let us read this question. ABC Limited is evaluating a project which requires an outlay of rupees 20,000 and is expected to produce cash inflow for 3 years as follows. So you have been given the information about cash inflows along with associated probabilities for each of the 3 years. If you carefully observe, the data given for year 1 and what is given for year 3 are exactly the same. So you can carry out the calculations for year 1 and year 3 in common. It is asking you to evaluate the proposal on the basis of CV with respect to NPV, given that risk-free rate is 6%. So here when we apply Hiller's model, what we will have to do, we will have to first determine the standard deviation with respect to EVCF for each year. Then we compute the expected NPV and standard deviation with respect to NPV. Then and then only we will be able to arrive at CV with respect to NPV. So let us look into how to present your solution. Your solution begins with computing EVCF. So for year 1 and 3, as I said, EVCF calculations will be common because the data is same for year 1 and 3. Separately you can make the calculation for year 2. So write up these calculations quickly and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and start determining the standard deviation of EVCF. First we will make the calculation for year 1 and 3. Now this is nothing new for you. What you have to do is you have to plot the cash flows. Then you take the deviations, that is cash flows minus expected value of cash flows. We are identifying deviations as D. Then you compute D square values and then plot the probabilities of each of these outcomes, and you take the last column as D square into P, and taking the summation of D square into P, it will give you the variance with respect to EVCF, and standard deviation with respect to EVCF will be the square root of the variance, which comes to 3098 for year 1, and the same will be the calculation for year 3. So mind it, calculations for year 1 and 3 have been made common. So please write up this entire working and then I take you ahead. Alright friends, once you have completed writing this entire working, let us move ahead and now make the standard deviation of EVCF calculation for year 2. So you do the same thing what you did for the other 2 years. You compute the deviation, take the squared value of deviation, multiply the respective probabilities to deviation squared. The summation of D square into P would give you the variance, and square root of the variance will give you standard deviation with respect to EVCF, that comes to 2530. So please write up this entire calculation and then I take you ahead. Alright friends, once you have computed the standard deviation with respect to EVCF, let us move ahead, and now what we do is we compute the expected NPV. This is again a simple task. You identify the EVCF for each year and multiply the same to their respective PV factors, and what you get is total PV of EVCF acting as total PV of cash inflows. From that you subtract the PV of cash outflow to obtain the expected NPV as 4950. So please write up this calculation and then I take you ahead. Alright friends, once you have completed the computation of expected NPV, let us move to the last part of the solution, where we first determine the standard deviation with respect to NPV. Keep in mind one thing, we are applying the Hiller's model over here. So we have to plot the calculations for 3 years that is the standard deviation of EVCF for 3 years, PV factors at 6% for 3 years. Then we compute the present value of standard deviation with respect to EVCF by applying the PV factors that we have identified, and then we take the squared value of the present values. So when you apply the square of the present values, the PV squared column, you can take the total, and that will give you the variance of the project NPV, and the standard deviation of NPV will be nothing but the square root of the variance, and that comes to 4514.49. And finally, when you have to compute the CV with respect to NPV, it will be standard deviation of NPV divided by expected NPV, and that would give you 4514.49 divided by 4950, that gives you 0.912. And I have explained you earlier what is the interpretation of CV with respect to NPV. For every 1 rupee of NPV, the standard deviation in the form of risk is 0.912. In other words, for every 1 rupee of NPV that you earn, you are taking the risk of 0.912. So please write up this working, and that will be end of the solution. Alright friends, once you have completed this entire solution, let us move ahead and take up the next question, that will be question number 18. Let us read this question. This is one of the questions from your institute study material. It says Skylark Airways is planning to acquire a light commercial aircraft for flying class clients at an investments of rupees 50 lakhs. The expected cash flow after tax for the next 3 years is as follows. They have given you year 1, year 2 and year 3 cash flows along with their probabilities. The company wishes to take into consideration all possible risk factors relating to an airline operations. Company wants to know the expected NPV of this venture assuming independent probability distribution with 6% risk-free rate of interest. And then the second part of the question says the possible deviation in the expected NPV. Now here we have to first compute the expected NPV and then the standard deviation with respect to NPV. Of course, we will be applying Hiller's model because we have independent probability distribution. So let us begin with the solution over here. In the solution, we first work out the EVCF for each year. I don't have to explain you these calculations, you know how to do this. For each of the 3 years, the expected value of cash flow has been computed. So quickly write it up and then I take you ahead. Alright friends, once you have completed writing this entire calculation, let us move ahead and now we compute the expected NPV. So for this purpose, for each of the 3 years, you take the EVCF and apply the PV factors at 6% discounting rate to obtain PV of EVCF, aggregate of which will be total PV of EVCF, which acts as good as total PV of inflow, and from that you subtract the PV of outflows. What you get at the end is expected NPV. So please write up this entire calculation and then I take you ahead. Alright friends, so once you have computed the expected NPV, let us move ahead and start computing the standard deviation with respect to EVCF for each of the 3 years. Again, it will be cash flows, then cash flows minus EVCF for computing deviations. Then you have the respective probabilities, and once you plot these probabilities, take the deviation squared value, that is D square. Deviations have been symbolized as D, probability is P, so D square into P. When you identify the aggregate or the summation of D square into P would give you 85.4, which is the variance with respect to EVCF, and when you compute standard deviation of EVCF, it will be the square root of the variance, which comes to rupees 9.2412 lakhs. So please write up this entire working and then I take you ahead. Alright friends, once you have computed the standard deviation with respect to EVCF for the first year, in the same manner you will calculate the same for the second year. You plot the cash flows, you take the deviations, you identify the probabilities, then take d square into p, take summation of d square into p, which represents the variance with respect to EVCF, and the square root of the same would give you the standard deviation with respect to EVCF. That comes to rupees 9.9303 lakhs. So please write up this working and then I take you ahead. Alright friends, so once you have completed this entire working, let us move ahead and do the same thing for the third year. For the third year again, you compute the standard deviation with respect to EVCF. So plot the cash flows, identify the deviations, plot the probabilities, and then compute d square into p. Take the summation which gives you the variance with respect to EVCF, and the square root of the same would give you the standard deviation with respect to EVCF. That comes to rupees 8.6192 lakhs. So write up this entire calculation and then I take you ahead. Alright friends, once you have completed this entire calculation, you should be clear that this is the first step in Hiller's model, and the later steps when you have to apply for computing standard deviation with respect to NPV, you just identify that the project life is 3 years, so you plot the standard deviation with respect to EVCF for the 3 years. You compute the present value factors at 6% and then take the present value of standard deviation with respect to EVCF. Thereafter you apply the squared value of the present values, and the aggregate of this squared value of present value, that is summation of PV square, would give you the variance with respect to NPV. Taking the standard deviation of NPV would require the square root of the variance, and that would be rupees 14.3696 lakhs. So please write up this entire calculation and then I take you ahead. Alright friends, so once you have completed this entire solution, let us move ahead and take up yet another question for practice, that is question number 19. This is exactly similar to the one that you have just solved as question 18. Now here I don't want to get in between. I would want you to try out this entire question on your own. The maximum time that you should take should be 12 minutes, and therefore I'll give you exactly 12 minutes to try it out. You try out this calculation, and once I show the solution, you can take note of the entire solution in your fair work. So I have given you 12 minutes time. Your time starts now. Alright friends, I have given you enough time to try out this calculation. So let us see whether you have got the correct calculations for each working, starting with EVCF for each year. So I am sure you would have got all these calculations correct. I give you a minute of time over here to check your calculations and then we move ahead. Alright friends, once you have completed writing this entire working, let us move ahead and check the expected NPV calculation that you have done. I am sure you would have done it correct, but still please check each of your calculations, where the total PV of EVCF would come to 71.944 lakhs, and subtracting the PV of outflow, you get the expected NPV as 21.944 lakhs. So please check, and once you are clear with this, we move ahead. Alright friends, once you are done with this, let us move ahead and compute the standard deviation with respect to EVCF for the first year. When you attempted this calculation, I am sure you would have gone correct with this. Just look at the calculations. Standard deviation with respect to EVCF should be rupees 7.8746 lakhs. Please check this and then I take you ahead. Alright friends, once you have completed the calculation of year 1, in the same way you make the calculations for year 2. Check whether you got this whole thing correct. The standard deviation with respect to EVCF should be rupees 9.7596 lakhs. Please check it and then I take you ahead. Alright friends, once you have completed the standard deviation of EVCF for second year, let us make the same calculation for the third year. When you attempted, you would have got exactly the same calculations. Just check and make sure that you have done it correctly. The standard deviation with respect to EVCF for third year comes to rupees 9.7077 lakhs. So please check this and then I take you ahead. Alright friends, once you have completed writing this working, let us move ahead and deal with the last part, that will be standard deviation with respect to NPV. So when you have computed standard deviation with respect to EVCF, applying Hiller's model and computing the present value of standard deviations and then taking the squared value of present values, the aggregate of the squared values of present value will give you the variance of the project's NPV, and square root of the variance would give you the standard deviation with respect to NPV, which comes to 14.0382 lakhs. So please make sure that you got this calculation. Once you have checked this, it will be end of this particular solution.